Well, we'd like to start the new year with the best possible gift of all, which is a hearing. So I'd like to call the Assembly Committee on Banking and Finance to order for the hearing. We will, just by way of agenda, we will have the hearing on the California Finance Lenders Law, Consumer Protection and Potential Reforms first. We will, of course, call a quorum if we see one, but we will actually not discuss Assembly Bill 336, which is the only substantive bill on the agenda for this afternoon. We probably will not reach there for maybe about an hour and a half or so. So I'd like to first of all thank all of our guests and members in attendance, especially those of you who asked us to have a hearing like this. This is a incredibly important issue, which is that, especially in a down economy, the question is what options are there available for low income and high credit risk working families, or those that have those characteristics. And we've often discussed issues such as payday lending. We're going to later on hear a bill on car title lending. I will just make a few opening comments. I will then ask our esteemed Mr. Vice Chair if he would like to make any comments, and any committee members. And then, of course, we will proceed with our first, shall I say witness, or expert witness, I should say. So with California's economy, as the credit markets tightened up and reduced the options available to consumers, many found that they had very few options. For those that needed a loan of a few $1,000s, the finance lenders can fill that void. However, the cost to the low-income borrower is high, as there is no cap on interest on loans over $2,500. For those that use their car as a collateral for loan, as it is for borrowers that seek out unsecured loans, perhaps via the internet, they may pay triple-digit interest rates. And what is the debate? What is the issue? The issue is this. The issue is whether a product can be offered at a reasonable interest rate using a scale and model that provides effectiveness for the lender, but at the same time provides the borrower with a low-cost solution. The issue is not easy, as we shall see from those that speak today. And what should this hearing do to achieve success? A successful hearing will not just flesh out the major issues, but get us thinking outside the box. How can we start the new year dedicated with new ideas, if that is appropriate? Near the end of the hearing, we will hear from Mr. James Gutierrez, the CEO of Progreso Financiero and the sponsor of Senate Bill 1146, a bill that I had the opportunity of getting to know a little bit better when Senator Flores was here, which established the pilot program for affordable credit building opportunities, while the California Finance Lender Law was used in order to expand lending opportunities for low-income borrowers. Mr. Gutierrez will provide unique insight into the law and its effect on low-income borrowers, as well as the challenges that exist in reaching this market under that new option. Finally, I would like to point out that the industry panel is made up of representatives in the car title lending industry. We did invite representatives of the other aspects of the finance lender industry, but they were not able to be with us today. However, this should not limit the testimony of any of our panelists on the overall consumer lending environment created under the CFL. So we will have an overview with the Commissioner of Corporations. We will have industry commentary. We will have consumer concerns. And then we will have public comment. And then, as I stated earlier, we will take up Assembly Bill 336. At this time, without any other delay, I'd like to ask my esteemed Mr. Vice Chair if he would like to make any comments.
Thank you, Mr. Chair. Please allow me first to wish you and our colleagues and our audience a happy and productive New Year. To all concerned, it's good to be back and back to work. I like you, I agree that the timeliness of this hearing material couldn't be better. As our economy is what it is, a lot of people looking on less traditional loans at what's available out there, which also creates a problem. It's good to be here, and hopefully we'll hear from all of our concerned members from the industry itself and those who are out there looking for loans, if they're lenders, regulators, and others all combined. Obviously, the problems that exist with lending regulations and the more need for the consumers to borrow has created some level of increased friction. And I'm looking forward to hear from what our folks here will testify today, and hopefully that will aid us in coming up with some solutions. As I said, looking forward to hear the good, the bad, and maybe not so good, and hopefully working together we'll create a solution where we can all benefit from what we have available. Obviously, often we point the finger towards the industry, but myself being a small business person who's been there and done that, times are tough. The same backstand we're accustomed to going and shaking hands and walking away with a loan does not exist today. And most businesses who are accustomed to that, obviously, if you look at our financial reports, that's not what it is. Our property values is not what it is, or used to be, I should say. So all that has created some level of problem, but I'm looking forward that with the help of us, without getting in the face of those businesses, that there'll be some guidelines to help those who need the help the most, and looking forward to working with my colleagues and especially with you, Mr. Chair.
Thank you very much, Mr. Vice Chair. We also would like to welcome to the dais here members of the committee, Mr. Mike Gatto, who's in the leadership of the California State Assembly, Mr. Morrill, who's the Vice Chair of the Assembly Committee on Labor, and Ms. Torres, who's the esteemed Chair of the Assembly Committee on Housing, if they would like to make any introductory comments, and they will proceed post haste to our very first expert witness. Well, thank you very much for those brief comments. Thank you very much. Our first expert witness is, we're honored to have the Commissioner of the Department of Corporations, Ms. Jan Owen, who proactively stopped my office, and we had a very, very good discussion. Commissioner Owen has had a decades-long career of public service, including a stint as acting director of the Department of Financial Institutions. And if you read her resume, you will need several lengthy minutes, as it is quite long and distinguished. So if Commissioner Owens, I believe, Commissioner Owen, would you like to come up here and join us to address the regulation environment of the CFL? Welcome to the committee.
Thank you, Mr. Chair.
And with the changes that are going on that have been proposed, I know that you're in a very, very good position to bring about the kind of proactivity that's needed to make those changes possible.
Thank you, sir. Can you hear me?
If you can put the mic a little bit closer to you. Yeah, thank you.
How's that, better?
Yeah.
Better.
There you go.
There we go. Good afternoon. I'm Jan Owen. Recently appointed commissioner, 9 days and counting, with the Department of Corporations. I have with me Colleen Monahan, who is our deputy commissioner with policy and legislation, to hopefully answer any additional questions. You talked about my resume, Mr. Chair. I always like to say it's because I'm old and have been around here for many, many years. The committee asked us to provide background information on the California Finance Lenders Law and a current update on consumer lending activity under the law. The California Finance Lenders Law was added in 1994. It represents a consolidation of 3 previous lending laws: the Personal Property Brokers Law, the Consumer Finance Lending Law, and the Commercial Finance Lending Law. The predecessor Consumer Finance Laws and Small Loan Act and Personal Property Brokers Law date back to the early part of the previous century. Types of consumer loans that are made under the California Finance Lenders Law. We regulate both consumer and commercial lending and the brokering of loans made by finance lenders. Loans made and brokered under this law may be unsecured, secured by real property or personal property such as automobile titles, or secured by both real and personal property. In 2010, the department licensed and regulated 2,261 lenders and brokers at 4,327 locations, again, under the California Finance Lenders Law. These lenders made over 2.5 million consumer and commercial loans totaling $114 billion. Of the total dollar amount of loans made under this law, consumer lending made up 18.8% of the total loans made in 2010, while commercial lending accounted for the remaining dollar amount. Short-term and small dollar consumer loans. Protections under the California Finance Lenders Law are tiered based on the dollar amount of the loan. This tiered structure of regulation has existed from the initial enactment of laws regulating secured and unsecured consumer loans. The first laws capped interest rates on loans under $300, while loans at amounts above this threshold were not subject to interest rate caps. Borrowers of high dollar amounts were assumed to have the ability to protect their own interests when borrowing higher amounts. The regulation of consumer loans secured by personal property first secured in 1909 with interest rate limits imposed on loans of less than $300. In 1918, the first usury laws were enacted capping interest rates on all loans. However, the restrictions placed on access to capital ultimately resulted in the adoption of usury provisions in the California Constitution, providing an exception for specified classes of lenders, including consumer finance lenders. The constitutional amendment also provided the ability to regulate the lending practices of exempt classes of lenders to the discretion of the legislature. Today, the California Finance Lenders Law restricts interest rates on loans of less than $2,500. While interest rates are not capped for loans over $2,500, other fees are capped for loans up to $5,000, and fewer borrower protections are statutorily specified for loans over $10,000. In 2010, over 203,000 consumer loans under $2,500 were originated, or 42% of total consumer loans made under the Finance Lenders Law. By comparison, during the same period, more than 12 million payday loan transactions were made under the California Deferred Deposit Transaction Law, which the department also administers. Payday loans may not be more than $300, and the fee for the loan cannot exceed $15 for every $100 borrowed. The APR averages in excess of 400%. Interest rate ceilings under the finance lenders law are capped based on unpaid principal balanced per month, ranging from 2.5% per month on the first $225 to 1% per month on the outstanding balance from $1,600 to $2,500. Because the APRs are based on fees and the length of the loan, it is possible for a small loan of short duration to have an APR that exceeds 90%, but typically the APRs are substantially lower, with the interest rates most frequently ranging from 30 to 39% APR. Of the over 203,000 consumer loans under $2,500 made in 2010, more than 90% were unsecured, and almost 85% of them were originated by only 2 licensees of our department. An auto title loan is a short-term loan, typically 12 to 36 months, in which a borrower with clear title to his or her vehicle may immediately receive a loan secured by the borrower's vehicle without regard to the borrower's credit history. These loans typically have a high interest rate. Auto title loans may be characterized as a subprime financial product that provides access to credit for borrowers who may not be able to obtain credit from conventional lenders. These loans differ from traditional auto loans, which are financed and secured by a lien on the vehicle in the purchase of the car. Under the California Finance Lenders Law, the borrower of an auto title loan provides the vehicle ownership certificate to the lender as security for the loan, and the borrower keeps possession of his or her vehicle during the term of the loan. Auto title lenders lend in amounts above $2,500, and therefore the loans are not subject to interest rate caps in the finance lender law. Also under the finance lender law, auto title lenders may repossess and sell the borrower's vehicle if the borrower defaults on the loan. According to the department's records of auto title lenders that are subject to a regulatory examination in 2010, the auto title lenders that were examined made a total of 5,838 loans in 2010 and repossessed a total of 246 loans from borrowers. The auto title loan market under the finance lenders law in 2010 consisted of a total of 34,146 auto title loans totaling over $123 million. These were made to 463 licensed locations of 49 lender licenses. Of all these lenders made auto title loans with annual percentage rates exceeding 40%. 14 of the 49 lenders primarily made loans with APRs over 100% on more than half the loans originated. An additional 5 lenders made loans with APRs over 100% on at least 15% of the loans made. The average loan size was approximately $3,600. In 2011, the department issued licenses to 16 new companies that intend to make and/or broker auto title loans. In 2010, the department received 26 complaints concerning auto title loans, primarily concerning interest rates and business practices. The department conducted 36 examinations of auto title lenders in the past 2 years and cited licensees for violations including overcharging borrowers for interest and fees such as administrative or unauthorized miscellaneous fees, paying referral fees to non-licensed persons, and failing to maintain required documentation such as repossession logs and bids evidencing the auto's fair market value. As a result of these examinations and investigations, auto title lenders were required to refund to borrowers over $861,000 in overcharges in 2010 through November of 2011. In addition, the department revoked the license of an auto title lender and barred individuals associated with that lender from the lending industry. I'll talk a couple minutes about unsecured small consumer loans over $2,500. Unsecured consumer loans over $2,500 are not subject to interest rate restrictions. In 2010, over 105,000 consumer loans in the amounts of $2,500 to $4,999, or 22% of total consumer loans under the finance lender law, were originated. More than 46% of these loans were unsecured, while 39% were secured by automobiles. Thus, 49,267 of the loans were unsecured. In addition, almost 24% of the loans in the $2,500 to $4,999 range had interest rates between 40% and 99%, and more than 33% carried interest rates of 100% or more. Of the over 60,000 loans with principal amounts between $2,500 and $4,999 and an APR over 40%, over 29,000 were unsecured loans. Licensees reported made fewer loans with principal amount at or above $5,000 during 2010. Licensees reported 18,176 unsecured loans of amounts between $5,000 and $9,999, with 833 loans having an APR over 40%. Licensees reported making 2,263 unsecured loans at or above $10,000, with 583 loans having an APR of over 40%. The committee specifically requested information regarding the implementation of the pilot program for affordable credit building opportunities. Effective January 1st of 2011, Senate Bill 1146 created a small loan program, the pilot program for affordable credit building opportunities under the finance lenders law. The purpose of the pilot program is two-pronged. Number one, to encourage development of an affordable small consumer loan market in California, and two, to increase the availability of credit building opportunities and financial education to individuals who do not have the access to mainstream credit options, including those with minimal credit history and the unbanked who's without a transaction account with a financial institution. According to the Senate legislative analysis of Senate Bill 1146 in August of 2010, unbanked individuals constitute approximately 20% of Americans. Higher interest rate and larger fees allowed under the pilot program. To ask lenders to make more small unsecured consumer loans from about $250 to under $2,500. Lenders under the pilot program are permitted to charge borrowers marginally higher interest rates and larger origination fees and delinquency fees than those permitted for traditional loans under the finance lenders law. Specifically, the interest rates under the pilot program are capped at 2.5% per month on an unpaid balance of the loan up to and including $1,000, and 2 1/6 per month for unpaid balance of loans in excess of $1,000. Under the finance lenders law, finance lenders not participating in the program are limited to interest of 2% on unpaid principal balance from $225 to $900, a 1.5 from $900 to $1,650, and a percentage point per month from $1,650 to $2,500. Origination fees under the pilot program are capped at a maximum of $65 versus $50 for non-pilot program loans made under the finance lenders law, and permitted delinquency fees are also higher and capped at no more than $12 or $18 depending on the number of days the borrower is delinquent. Lenders under the pilot program may excuse me, only make unsecured loans from $250 to under $2,500, and minimum repayment term under the pilot program may not be less than 90 days. Traditional loans under the finance lenders law do not have a minimum amount, loan amount, or minimum loan term. To further encourage small loan lending under the finance lenders law, the pilot program permits lenders to market their loans through finders or unlicensed businesses and individuals who are paid on a commission basis to market the loans to consumers for the purpose of reaching prospective borrowers. This is a significant change from what is permitted outside of the pilot program. The use of finders under the pilot program is intended to allow greater access to affordable credit by reducing the regulatory requirements for unlicensed locations that are not negotiating the terms of the loan.
I'm going to ask, and first of all, thank you very much for that very fact-filled introduction. I'm going to ask if maybe you could wrap it up in about 5 minutes.
I can.
And because I want to give members an opportunity to ask questions. Welcoming to the dais the Chair of Appropriations, Mr. Felipe Fuentes. Thank you very much for joining us today. And Assemblymember Harkey, who I had the privilege of serving on housing with you under Ms. Torres, has also joined us. And I want to just make a comment and thank the members for being here. I know that this is the first full day back, and after last week, and I know all of you have a lot on your plate, and these are the good people of the committee that really take the time to understand the policy issues, and I want to commend them and give them an opportunity and hope that you ask questions, because this is kind of one of those once-in-a-lifetime opportunities to raise the big issues. And I know that these members are really about those big issues. So if you could maybe wrap it up in a couple minutes.
You do have a copy of the...
Okay. And before we do that, because quorum, like youth, is fleeting, we better grab it while it's still here. I'd like to, first of all, welcome back our committee secretary, Tiffany, that has been absent for too long of a while, but just a little while. If you could call the roll.
Ing.
Here.
Ing here. Shajian. Here. Shajian here. Calderon. Fletcher. Fuentes. Present. Fuentes here. Gatto. Gatto here. Harkey. Here. Harkey here. Atkins. Lara. Morel. Here. Morel here. Perea. Torres. Here. Torres here.
We have a quorum. We won't be taking up the Assembly Bill 336 until later on, but we did want to catch that quorum. If you might perhaps wrap up and talk about if there's any particular, how many applications under the pilot program, how many have been approved, denied, the reason for the denial, and then I'd like to go to questions.
Great.
Maybe a little bit of a capsule on the facts.
I'll just do the status on the pilot, and then I'll open it up.
Great.
Since January 1st of 2011, the department has received 3 applications and approved 1. The department has allowed the licensee to use a finder at 2 locations in Southern California. The department has not approved the remaining 2 applications because the applicants have not provided evidence of the required credit education program or seminar. One of the applications has been pending with the department for more than 8 months, and the other application has been pending for more than 3 months before the applicant withdrew the application. The applicant indicated it may reapply at a later date. One of the applicants stated that developing an in-house credit education program as a prerequisite for participating in the pilot program was very time-consuming. We've provided in your documents a chart that compares the regulatory requirement of the loans at various principal amounts under the finance lenders law.
Everybody again.
For all the loans under Affordable Credit Building Opportunity Program and all the loans under the Deferred Deposit Transaction Account. Thank you very much for your time, and I'm available to answer any questions.
Thank you, Madam Commissioner.
I'm going to admit that I will defer to Colleen.
Absolutely. And I also want to make a clarification. The other members of the committee who are not here are also just as good. They may just have other obligations like voting on bills.
There you go.
I didn't want to disparage anyone for not being here, although extra ice cream for those that are here.
That's right.
All right, committee members, any comments or questions? This is a rare opportunity to talk to our Commissioner of Department of Corporations. Any questions?
Just a comment if nobody else has one.
Yes, Ms. Harkey, and
I
then
apologize
Mr.
that I
Shajan.
wasn't here for the entire briefing, and I do thank you for coming forward. I will review this
Please.
tomorrow morning's reading with my coffee, I promise you. Thank you very much.
Thank you. And you know we're available to talk with you. Just call us.
Sure.
Great.
Thank you.
Yeah, okay. All right. Mr. Shajan, I think, had a comment, and then Mr. Morrell.
Thank you, Mr. Chair. And I also want to thank you for your time, and kind of wish we had this earlier so we prepare asking questions and put your time in be more valuable. I've heard of moving target, but seems like some of this stuff you're talking about is really a moving target. And what I was glad to hear that there are applications and more people have applied, because the more of them, hopefully competition will be the answer to the game. When I hear Mr. Chair and yourself talk about 3-digit interest rates, there got to be a reason. Either not too many people are doing them, or it's a very risky business that otherwise it's not worth getting into the business. So hopefully, before we meet next time, there'll be a lot of information here that will answer my questions. And if not, I'll look forward to possibly have a meeting with you on one-on-one and have a discussion. Thank you for your time.
Thank you.
Mr. Morrell?
One quick question earlier. Thanks again for coming.
Thank you.
You were mentioning a lot of figures, so I didn't write any of them down, but I heard one of them that you mentioned about how many auto loans were done and how many repossessions there were. And it sounded like off the top of my head when I did the math quick, you don't have to look it up, but approximately 4% of the loans were repossessed, meaning 96% went through, which that sounds like, 96% is paying it. But I just wonder, over the last 20 years, what is the average percentage for repossession, would you know? So in other words, because 96% sounds good that they're paying, I just wonder if that 4% now is high compared to 5 years ago or
20
low.
years ago.
Yeah.
Can I get back to your office?
Yeah.
Yeah.
I was curious.
Thank you. Ms. Torres?
Thank you for being here, Jan. I appreciate your presentation. Under tab 4, this is also part of your presentation, correct? Can you explain a little bit under the interest tab how that has gone from, in 2007, 19,283 to 2011, 787, 328? Can you comment on that a little bit?
The high amount in the increase in the refunds we've requested, and that
These are the refunds to the borrowers for the overcharges done by the lenders that we have seen through examination. So we told them they had to give the borrowers the money back.
so what it might consist of is when we find their documentations not matching the charges from their contract, the loans they're charging doesn't match what they have in the contract, or it could be charges and fees are tiered under the law, and sometimes costs will be added to the principal balance of the loan that we would disallow, and so the principal falls under an interest rate cap that entirely changes the structure of the loan, resulting in a substantial amount of money due back to the borrower.
That's quite a bit of money. I mean, we're talking about over $500,000 of interest returned to the borrower. Is there a reason other than, what is the reason from 2007 having less than 20,000 to, 2011?
Right,
3 years.
right. And there were some other high numbers here, but to get more background on the context of that interest, I will get that to you.
Okay.
I don't have additional background
fine.
details on those.
Thank you.
I'm going to ask Mr. Fuentes, and then we'll come back to Ms. Harkey.
Thank you for being here, Ms. Owen. Along those lines, in terms of sort of the overage that was paid back to the consumer as a result of being, was that overcharged in their interest, the calculation? I didn't hear sort of the rationale for that.
It is overcharged by the lenders to the borrower.
Now, I glanced through this, and I'm going to do what Ms. Harkey is going to do here and take a look at this. It looks very interesting. It looked like there was 26 complaints and only 36 examinations. Is that correct? Mm-hmm. And so the money that was returned was a result of the $500,000 or so. Was that a result of just the 36 examinations?
Of our examination.
And so can you help
From
us?
2010 and 2011.
So only 36 cases out of the entire sort of population of cases netted $500,000?
I think the 36 was auto title lending examinations,
Okay.
but the figures of
That's right.
refunds is much broader.
I see. And so, is there a chart that sort of gives us an idea of how much was refunded in each of the different categories? For example, auto loan.
The auto loan is the lower chart.
I
We do
see.
have
Okay,
that
very
one,
good.
and actually that is the higher number there.
And how do you do the examinations? Are they complaint driven, or do you do selective audits? How do you sort of populate?
Both.
Okay, very good. And so if you identify, let's say, a particular situation or instance where there are more sort of overages or miscalculations in terms of interest, is there a penalty action that is taken against that loan entity? Or
We can take an enforcement action if you want.
Depending on how we see violations, more minor violations or violations that aren't repeated, or that maybe a dispute over the meaning of certain statutory language may not result in more than corrective actions during exams, and then there's escalating remedial action we could take depending on what the violations are and
what does that forum look like? I mean, is it an administrative law judge sort of review? I mean, is there a place where you filed the complaint, but how do you sort of understand what the threshold is to decide what the sort of remediation or penalty or subsequent enforcement ought to be? How is that sort of tiered, and is there room there for more sort of direction from the legislature?
it's discretionary based on what we're seeing. It's discretionary. The type of disciplinary action we would take ordinarily in an examination, we're going to identify deficiencies that we spot while reviewing the loan files and request various corrective actions based on what we're finding. That corrective action might occur during the exit interview. If it's minor, might require follow-up information, and depending on what we're finding and the egregiousness of the violations, it could result in subsequent enforcement actions, revocations of licenses, penalties.
Sure, and this will be my last sort of question or comment, I guess. So what is sort of your reference to decide whether it's egregious or not, or just a simple sort of oversight? I mean, what do you sort of look back to decide that? I understand it's discretionary, but is there a sort of a board or a commission or a panel that sort of decides sort of what's inbounds and out of bounds?
No, it would be based on, well, the way the decision would be made would be based on consumer harm, egregiousness, the volume of occurrence, and it is pattern of practice by that particular licensee. And it's more based on experience, similar treatment of similarly situated violators.
So it's the examiner that has the discretion?
No, these go up these are all reported through levels of supervisors and managers as to what occurs in each examination.
Is there a hearing process?
Yes, if we bring an action, there is a hearing process if we bring an action against someone's license, and within the examination process, we have an ombudsperson for disputes within that process, and beyond that, a licensee is always entitled to a hearing process for any final decision of the commissioner, the department.
Thank you. Well, before we take Ms. Harkey's perhaps final comment, I'd like to welcome Assembly Member Majority Leader Calderon to the dais. And also for those of you that arrived, we are going to postpone the vote on Assembly Bill 336 at the conclusion of the hearing. Just to follow up on Mr. Fuentes, I noticed that on your exhibit concerning complaints under the Consumer Finance Lenders Laws excluding mortgage-related complaints, in 2007 you had 279, and then they seem to go down to almost half, assuming in 2011 you didn't have a big spike at the end. It went down almost by more than 50 or 60%. What do you account for that? Is that because there are less complaints, or do you think we need to do a better job in terms of eliciting proper complaints?
Oh, I think that's a very good question.
As the economy worsened, your complaints almost went down by not just a half, but more than a half.
I also think because it's complaint driven, that consumers knew who to call. In many cases in 2007, they didn't know who to call. They didn't, and now I think that's part of it, is they knew who to call. They knew, where their servicer was. They knew who their servicer's regulator was. I think that's part of it.
For the increase in mortgages.
Yes.
Yeah. But for the decrease in the consumer, I wonder if people are more accepting of their accepting of the high interest rates because of financial pressures. That would be speculation, though. We don't have.
I'd really like to get a handle on that. Maybe when you and I get together, Madam Commissioner, we really need to get into that. I'm not sure that's, it's like, unemployment went down because everybody gave up on looking for a job. I'm not sure if that's the kind of explanation. And what I really would like is maybe a critical examination of the complaint process. Is it working? Do we have outreach? Do people know where to go? Or is it just because there are less complaints? Ms. Harkey, you want to have the last word on this? Then we will be moving on.
Sure. I would just like to say I would think in both of these instances that were raised as to why fees escalated and then, interest rates or interest escalated, and also why the total of complaints dropped off. I think that in 2007, we had a lot of players in the field, many, anybody that could hang a shingle was in the business. And I think that kind of consolidated as the market downturn became more and more real. And I think that probably with regard to, people were pretty much staying. 2007 was not, 2008 was the big crash. So anything after 2008 would have been, that's when we knew it was systemic, it was worldwide, there was a lot going on. And so I think that people's eyes opened up in general, and they started examining their loan documents. We found out the different varieties. I, being in an industry of banking and corporate finance for years, had no idea of some of the types of loan programs that were out there. We wouldn't have done that years
And the
ago.
types of businesses.
Yeah, so I think it's all, we had a boom, we had a crash, and then we had a re-examination. And I wouldn't be surprised to find that a lot of these things have either increased because of awareness and or decreased because there's only the strong have survived and the good business practices are still in business.
Consolidation of the industry. We will get...
Listen, thank you very much, Madam Commissioner. Thank you, members. This is what we're planning to do. We're going to go right away to the next panel, which is the industry panel. I think that one, we will be going into more depth when Assembly Member Dickinson brings up 336, but we definitely would like to hear from you if you'll start coming up here. And then we're going to go into consumer concerns related to products offered by the CFL licensees. Then we'll conclude by comments on the pilot program, and then we'll go right into 336. At this time, we are honored to have the following individuals. Ms. Joanne Betancourt, on behalf of Equal Access Auto Lenders of California, welcome.
Thank you.
Mr. Oscar Rodriguez, the COO of 1-800 Lone Mart, welcome to the committee.
Good afternoon. Thank you for having me.
And Mr. Joe Lang, on behalf of Community Loans of America, and I assume we'll go in the order that I just announced. If each of you could take, but maybe 3 or 4 minutes, and then we'll get into some questions, and then we will get into more detail on the specific bill. We will have a separate hearing on that, and so you'll have an opportunity to speak on that specifically. But for the time being, if you will address the general industry concerns, we'd appreciate it.
Absolutely. Well, for the record, thank you, Mr. Chair and members. Joanne Betancourt, representing the Equal Access Auto Lenders of California. Thank you again for allowing us the opportunity today to speak regarding our industry, the auto title lending industry. Talk about title loans, the consumer protections that already exist, the multitude of the state and federal laws that title loans and title lenders have to comply with already. The Equal Access Auto Lenders of California is a California association made up of auto title lenders. Our members are licensed, regulated, and audited by the Department of Corporations, as you heard from the commissioner earlier. Now I think I'd like to introduce, I told you I'd be brief, Mr. Chair. Now I think I'd like to introduce to you Oscar Rodriguez, who is the Chief Operating Officer of 1-800-LOMART, but he also serves as the president of the association this year, and so we're pleased to have him, and he's going to give the bulk of our remarks. Thank you.
Just before that, I would like to again welcome to the dais another esteemed member of the Banking and Finance Committee, the Honorable Henry Perea, who is the chair of the California Assembly Committee on Revenue and Taxation. Thank you and welcome to the hearing this afternoon.
Good afternoon. My name is Oscar Rodriguez, and I'm the president of the Equal Access Auto Lenders of California, which represents all but about 2 or 3 lenders in the state of California that offer this product. What is exactly an auto title loan? An auto title loan is equivalent to a home equity loan, but for a vehicle. The borrower pledges a portion of the interest in the vehicle as collateral for a loan. This is unique in that the borrower can continue to drive their vehicle while making payments to the lender. Title loans are primarily used to meet short-term needs for medical, housing, home repairs, business requirements, and other unexpected life events. A qualified borrower can be processed and funded typically on the same day. As you know, car title loans lenders in California are regulated by the Department of Corporations. Title loans are fully amortized, simple interest loans with no prepayment penalties. Repayment plans are mutually agreed upon by both parties, and all terms are fully disclosed to the borrower before the transaction is completed, and I highlight before the transaction is completed. Consumer protections such as the Fair Credit Reporting Act and the Truth in Lending Act apply to this product. The consumer has the right to rescind the loan. Who uses auto title loans? The majority of the consumers who use title loans fall into 3 categories: moderate income who have damaged credit and do not qualify for standard loans at traditional lending institutions, low income unbanked customers who need money, and small businesses. It's the person who's had a foreclosure, a bankruptcy, and has funeral expenses that cannot walk into a bank or a credit union that needs the loan. It's a small business owner who is waiting to get paid from a vendor who needs to make payroll. It's the person who's been shut out of traditional banking due to bounced checks, overdraft issues, no credit card, with unexpected life events, and needs money. Often, the only other option aside from this product is the consumer to sell their vehicle at a discount to raise capital. Now imagine where that leaves a customer, their family, and their job. Since many report to the credit bureaus, since many title lenders report to the credit bureaus, finance customers that have been turned away, it's a great opportunity to reestablish credit with this loan. On average, a customer pays for about 1 year. Their credit, assuming that they pay on time, will increase between 50 and 80 points, which means in most cases that they have the ability to go from subprime credit to traditional credit once they're in traditional credit, obviously they're able to establish new credit at a significant reduction. The last part is this product is a viable product for tens of thousands of Californians a year in need of capital. With the continuing credit crisis, we need to find ways to create more credit products, encourage financial institutions to loosen credit standards to increase the supply of capital to Californians, especially the ones that need it the most, the subprime. Wiping out any type of credit that provides a useful option for customers and small businesses at the present time would be especially detrimental to the 7.1 million adult Californians with a credit score below 599. There is no better way to marginalize an entire group of working class people than to restrict their access of capital. True consumer advocacy is empowering Californians with financial freedom, giving them the ability to prove their creditworthiness, and fostering competition between lenders. Thank you. Any questions?
We'll maybe come back to questions after Mr. Lang. And I'd like to this time also welcome to the dais another member of the STEAM committee, which is a member of the California Assembly leadership, Mr. Ricardo Lara. Thank you, Ricardo. Mr. Lang?
Mr. Chairman, members, Joe Lang, representing Community Loans of America. We are an auto title lender with 20 locations here in the state of California. What we do, Oscar sort of described that pretty well. We make loans to primarily low to middle income people who have a clean title on their car and use the title on that car as collateral for the loan. Generally speaking, I think the commissioner related in her statistics that the average loan that my company makes to the consumer is in the neighborhood of $3,600. These loans are made to people who primarily have low credit scores. There could be a variety of reasons why they have low credit scores. The economic downturn being obviously one that it impacts us all. Job displacement, job changing, health issues, a variety of things that put these individuals in a place where they cannot access credit from traditional banks. They'll get turned away from traditional banks. And I think that is an important point to think about, is the environment in which we're making these loans today. We all hear about, and I've asked the sergeant to pass out a couple of handouts, which I think really pointedly make this point. This is from the 2010 annual report under the finance lenders law. And it shows exactly the environment in which we're making these loans. In the year 2010, there were 2,560,000 loans made under the finance lenders law here in California. That is about half of the amount of loans that were made in the same period in 2003. That shows you the impact of the economic downturn, and it shows you specifically how credit has tightened just here in California. While we will read in the media, the Wall Street Journal, other types of publications, how credit has tightened nationally and internationally, these numbers here tell a pretty telling story. Right here in California, the impact of that is a reduction of about 50% in credit availability. The individuals that we're making loans to, of that 50% left that qualify for loans in California, generally are people who do not qualify for traditional loans from traditional lending sources. Banks won't lend to them. Their credit scores are too low. Credit cards won't lend to them. Their credit scores are too low. We are a source that people can turn to when they need credit and need access to credit when the door's shut on them from every other place. There has been some question about the cost of these loans. And the cost is high. Interest rates are high compared to traditional loans. But I think it's important to look at what is the reason that those costs are high. There are at least two primary reasons. One is the cost of capital. The The cost of capital to make these loans is higher because it's well known that these are higher risk loans. These are individuals with low credit scores who can't qualify for traditional loans. So it costs us more to obtain capital to make these loans than a traditional bank who can go to the Federal Reserve and in an overnight bank rate get right now 0.5% interest. We can't borrow at anything close to that. So our cost of capital is higher. Secondly, our stores have one product. That's an auto title loan. So all of our administrative and overhead costs for servicing each store and for servicing those loans has to be factored into one product versus a bank that may have checking accounts, savings accounts, CDs, real estate loans. They have a broad array of products across which they can amortize their overhead. We have one. And as a result, that overhead is focused and becomes a higher proportion of our costs per loan. You add up those two factors, and yes, our interest rates are high, in some cases over 100%. I think what's important to look at, though, if you're going to ask why are the interest rates so high, is to compare our return on equity, if you would, our profit compared to other traditional lenders who won't service this market, by the way. If you do that and you look at the third quarter 2011 FDIC statistics, it's the latest quarter that's available, and I'll make these available. It's a rather thick document. But there were a couple of telling things. Credit card companies' return on equity in the third quarter of 2011 was about 23.9%. Consumer lenders across the broad spectrum of the types of consumer lenders there are in the country was about 18.9%. I can tell you, without giving away too much proprietary interest, but because of the two reasons I just talked to you about, the high cost of capital and the high amount of overhead per loan, our return on equity is about 21%. So we fall right in the middle of credit card companies at 23.9 and the broad range of consumer lenders at about 18.9% return on equity. So yes, the interest rate is high, but our return on equity, our profitability, is no different than other traditional lenders. The reason why the interest rates are high is that they're higher risk loans, our cost of capital is higher, and our overhead is sunk into one limited product. Something else that you might think about, because this is a source of credit that in fact may be the only source of credit that individuals like Oscar talked about who have their own businesses, who may be independent contractors. The last thing from an economic standpoint that you might want to do is, if the economy is beginning to recover, and we saw a good jobs report on Friday that there were 200,000 jobs added nationwide. If the economy is slowly starting to make a recovery, one of the most unfair things you could do is to take people's access to credit away when the economy is recovering. They need that credit to take advantage of the fact that the economy may in fact be starting to recover. That contractor needs access to credit to be able to do that next plumbing job and buy the parts ahead of time and pay his vendor after. And so I would